Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, I'm Vinay Joseph, Head of Investment Products and Strategy at Wealth Standard Chartered Bank, India. In today's episode, we discuss our recently released H2 2023 market outlook titled Keep Calm and Carry On. Now, as we enter in the second half for this year, two competing narratives are likely to influence Indian assets. First, India's robust domestic macro environment that remains ahead of its major peers, and second, a delayed but high likelihood of a recession in developed economies. Against this macro context, it is tempting to dial up risk by chasing either the equity rally or retreat in the comfort of fixed income, where yields are not as attractive as they were at the start of the year. We believe investors should keep calm and take a balanced approach in four ways. First, in the strategy of calm, C stands for capitalize on market opportunities through an overweight on medium and long duration bonds, high quality corporate bonds, and mid-cap and small-cap equities. A, allocate broadly, which is basically a diversified portfolio is likely to trump a concentrated portfolio. L, for lean to Asia, where we see value in sustained investment cycle beneficiaries. And M, manage volatility through opportunistic allocations, like through a barbell-like equity strategies. Now let's elaborate on each respective strategy. First, capitalize on market opportunities. Now here within bonds, we have done two upgrades. We have upgraded medium and long maturity bonds because in our view, this offers an improving risk reward as the yields are attractive despite the recent rally in bonds with 5-year and 10-year IGB yields trading close to their 10-year average. 2, there is a lower likelihood of policy rate cuts by the RBI in this fiscal year, given the RBI's focus remains on withdrawal of accommodation amid still elevated inflationary pressures. And 3, strong demand from institutional investors like mutual funds, bank, and insurers. We also like high-quality bonds, corporate bonds, which is basically the AAA bonds, because we see a favorable risk-reward relative to government bonds as they offer an attractive absolute yield. Spreads are likely to narrow amid improving corporate profitability and strong demand for these bonds, and their returns are likely to be less impacted by changes in RBI's policy stance given the cushion they enjoy from higher yields on offer. Lastly, within equities, we have upgraded mid and small cap equities to an overweight. Now, mid cap and small cap equities have rallied very strongly in the last quarter, outperforming their large peers. For example, in quarter 2 2023, the Nifty mid cap and small cap indices are up 19% and 21% respectively, compared to a 11% rise for Nifty index. However, in our view, this ongoing positive momentum in broader markets is likely to sustain, given three factors: positive EPS revisions for the mid-cap and small-cap equities compared to their large-cap peers for both FY24 and 25 earnings, more reasonable valuation since the start of 2023, as we have seen earnings delivery, and expectations of lower bond yields amid a peak in domestic policy rates. Now, moving to allocate broadly, what does that mean? Now, in this current environment of strongly competing narratives, we expect diversification to trump a concentrated approach. And within this, we advocate a core allocation across the level 1 asset class: equity, bonds, cash, and gold. It's important to have allocations to cash, gold, and liquid alternatives, as historically they have played the role of portfolio diversifiers. We continue to see a core allocation to gold as an attractive portfolio diversification, given its potential still remains, particularly against inflation and any short-term market volatility risks, which could be triggered by slower global growth, geopolitical tensions, or concerns on growth. The third theme, which is lean to Asia. Now, within our overall global outlook, we are positive on Asia ex-Japan equities and Asia bonds. Within India, we like structural themes which are beneficiary of sustained investment cycle revival and numerous supply side reforms, which is likely to ensure that this investment cycle Efficiencies are built in, there is ease of doing business, and we see competitiveness of domestic sectors. Now, within the two structural themes of the investment cycle, we like manufacturing and infrastructure. The outlook for India's manufacturing cycle has brightened over the last few years, with a decisive shift in government policy through higher capex commitments, structural reforms like the GST, insolvency, bankruptcy code, and the corporate tax rates, and government schemes like Make in India and the Production Link Scheme. These conditions are likely to facilitate the growth of indigenous manufacture capability and drive job creation. Additionally, the ongoing de-risking of global supply chain amid elevated risks of geopolitical tensions is a very strong tailwind for manufacturing sector. Now, moving to infrastructure, we like this because this remains a top priority of the government, and this supports India's medium-term growth outlook. A robust infrastructure would enable backward and forward linkages to other sectors and help efficiently integrate local and global markets. Governments increased its focus on key infrastructure sectors like road, rail, water, urban infra through increased budgetary allocation, and more importantly, the National Infrastructure Pipeline Plan, which inculcates a spend of INR 102 trillion across these key sectors by the end of fiscal year 2025. This is a very strong tailwind for the sector. Now, moving to the last strategy in our CA.L.M, which is M for manage volatility. Now, here we would like to use opportunistic allocations to manage volatility. And this is through first adopting a barbell-like sector strategy within equities by having exposure to domestic cyclicals, mainly financials and industrials, while also adding a defensive tilt through our exposure to healthcare. 2, we continue to believe exposure to hybrid and multi-asset strategies are going to be crucial, as they are potential routes to hedge against any intermittent spike in volatility, given its ability to allocate across asset class and capture short-term market opportunities. And lastly, look for opportunities to add exposures to assets that lower portfolio volatility, basically through the alternate baskets, through liquid alternate assets or long-short strategies. That's all for today's podcast. If you want to read our outlook, keep calm and carry on, please reach out to your relationship manager for a copy, or you could download the report from our website. As always, if you like the podcast, please subscribe. Thank you and have a great day ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.